Welcome back to Money Unfiltered, everyone. Today, Jane, we're diving into something I think a lot of our listeners are going to find really interesting, maybe even a little controversial. We're talking about those financial rules we grew up with, the kind of wisdom passed down through generations, and whether they still hold up in our modern economy.
Oh, Bob, I'm ready. It's funny, isn't it? We get these nuggets of common sense advice, often from well-meaning parents or grandparents, but the world has just changed so much. What was prudent in the 50s or 70s might actually be detrimental to wealth building today.
Absolutely. Let's kick it off with one that I hear all the time, and honestly, it's one I used to fully subscribe to. All debt is bad. Just stay away from it, pay off your credit cards immediately, never take out a loan if you can help it. That was the mantra.
That's a classic, Bob. And on the surface, it sounds responsible, right? Nobody wants to be drowning in debt. But this blanket statement completely overlooks the concept of good debt versus bad debt. It's a huge oversimplification that can actually make people miss out on significant wealth-building opportunities.
Okay, so let's break that down. What's the good debt in your book? Because for a lot of people, any debt just feels like a weight.
Think about it this way. Good debt is generally debt that helps you acquire an appreciating asset or generate income. The most common example is a mortgage on a property that, over time, is likely to increase in value. You're leveraging someone else's money, the banks, to buy an asset that grows in equity. Another great example is a business loan. If you're starting or growing a business, that loan could be the fuel that generates significantly more income than the cost of the interest.
So it's about using debt strategically, almost like a tool. Rather than seeing it as a burden, it's a means to an end for a larger financial goal.
Exactly. And the flip side, bad debt, is typically debt for consumption. Credit card debt for vacations, designer clothes, or even depreciating assets like a new car, unless it's absolutely essential for work. That's the kind of debt that doesn't generate value, only interest payments that drain your future earnings.
It's a really important distinction, because if you're so debt-averse that you avoid a mortgage, you might be missing out on building equity and capital appreciation in real estate. Or if you never take a smart business loan, you might stunt the growth of a potentially successful venture.
Precisely. The modern approach isn't no debt, it's smart debt. It's about understanding when debt can be an accelerant for wealth rather than a drag. And that leads us nicely into another big one. Your home is your best investment.
Oh, this one is practically sacred in some circles. The American dream, right? Own your home, build equity, it's your retirement nest egg. What's wrong with that, Jane?
Nothing is inherently wrong with homeownership, Bob. It provides stability, a sense of belonging, and it can certainly appreciate in value. But calling it your best investment or your only investment can be incredibly misleading and financially limiting. The problem is it often ties up a huge percentage of your net worth in a single illiquid asset.
Illiquid, meaning you can't easily convert it to cash without selling it, which is a whole process.
Exactly. You could be asset rich but cash poor, as the saying goes. Imagine having $1 million home but no diversified investment portfolio outside of that. All your eggs are in one very large, very slow-to-move basket. What if the local housing market takes a dip? What if you need access to cash quickly for an emergency or an opportunity?
I can see how that creates a lot of risk. If all your wealth is tied up in one asset, you're exposed to market fluctuations in that specific sector.
That's it. Modern financial advice suggests viewing your home primarily as a lifestyle asset. It's a place to live, to raise a family, to enjoy. Yes, it might appreciate, but your primary investment strategy should be building a diversified portfolio of growth assets, stocks, bonds, maybe even other real estate outside your primary residence, index funds, ETFs. That way, you're not solely dependent on the performance of your local housing market.
So it's not about saying don't own a home, but rather don't let it be the only star of your financial show.
Precisely. Your financial strategy needs to be broader, more resilient. And speaking of resilience, what about the old adage, cash is king?
Oh, this one definitely has its roots in uncertainty. In a volatile market or during economic downturns, having cash feels incredibly safe. It's liquid, it's tangible, you know exactly what you have.
And that feeling of safety is certainly appealing, especially when things feel shaky. But here's the kicker, Bob. Cash sitting in a bank account, especially one with low interest rates, is losing purchasing power every single day due to inflation. It's like having a leaky bucket. The water, your money, is slowly, silently draining away.
That's the invisible enemy, isn't it? We see our bank balance and it looks the same, but what it can buy is less and less over time.
Exactly. So while having an emergency fund is absolutely critical, 3 to 6 months of living expenses in an easily accessible savings account. Beyond that, holding excessive amounts of cash is a missed opportunity. Modern financial practice recommends having that emergency cushion, sure, but then investing the rest in assets that have the potential to grow faster than the rate of inflation. Assets that actually work for you, rather than just sit there.
So keep enough for immediate needs, for emergencies, but then put the rest to work. Don't let inflation eat away at your hard-earned money.
Exactly right. And that brings us to another huge misconception that I hear, especially from younger people, but really from anyone who feels intimidated by the financial markets. You need a lot of money to start investing.
Oh, I remember thinking that. Like you needed to have thousands, if not tens of thousands, just to even open a brokerage account or buy a single share of a good company. It felt like this exclusive club.
And honestly, for a long time, that was kind of true. But that idea is completely obsolete now. With the advent of technology, low-cost investment platforms, and things like exchange-traded funds or ETFs and fractional shares, you can literally start investing with $20. Or even $5 sometimes.
$20, that's incredible. So the barrier to entry is almost non-existent now.
It truly is. You don't need to buy a full share of a $300 stock anymore. Many platforms allow you to buy a fraction of that share. This democratizes investing. It means consistency and starting early are far, far more important than the initial amount you put in. The power of compounding interest over decades, even on small, regular contributions, is astounding.
That's a game changer for so many people who might feel like they're locked out of building wealth. Just start with what you can, consistently.
Precisely. The sooner you start, the more time your money has to grow. And that's a lesson that wasn't as accessible in previous generations, where those minimums were so high.
But wait, we've talked about home ownership. What about its counterpart, renting? Many people still cling to the idea that renting is throwing money away. Oh yeah, that's another big one. I hear it all the time. Why pay someone else's mortgage when you could be paying your own? It feels so intuitively true, doesn't it?
It does, Bob, but it's a huge oversimplification. Renting offers incredible flexibility. If your job moves, or you want to try a new city, or your family needs change, you're not tied down by a mortgage, property taxes, or the costs of selling. That flexibility has significant, often underestimated value.
That's a good point. The transaction costs of buying and selling a home are substantial.
Exactly. And beyond flexibility, there's a huge financial advantage. Renting frees up capital. Think about it. A down payment, closing costs, ongoing maintenance, property taxes, insurance. All that money, if you're renting, can be invested elsewhere for potentially higher returns. This is often called the rent versus buy calculation. And in many markets, especially when property prices are high or interest rates are high, renting can actually be the more financially savvy move.
So you could take that down payment money, invest it in a diversified portfolio, and potentially see better returns than you would have by tying it up in a house, especially if you consider all the associated costs of homeownership.
Absolutely. It allows you to separate your housing needs from your investment strategy. You can live in a place that suits your lifestyle and then strategically invest your capital to maximize growth and diversification. It's not throwing money away, it's a financial decision that could optimize your overall wealth accumulation.
Wow, this has really opened my eyes to how much traditional advice needs a modern update. So if these old money rules are outdated, what does modern financial management look like? What are the key principles we should be following?
That's the million-dollar question, Bob. Modern financial management is dynamic, strategic, and always has a long-term focus. It's about maximizing value, managing risk actively, and leveraging all the tools available to us today. One of the core tenets is strategic financial planning.
Strategic planning, so not just save as much as you can.
Much more than that. It's about aligning every financial decision with your long-term goals. Are you saving for retirement, a child's education, a second home, starting a business? Each goal requires a different strategy. It means regularly reviewing your income, expenses, assets, and liabilities, and identifying opportunities for growth, not just blindly saving.
So it's proactive, not just reactive to what's happening with your money.
Exactly. And related to that is value-based management. For businesses, this means focusing on creating shareholder value as the primary objective. For personal finance, it translates to making decisions that actively increase your net worth and financial well-being over time, rather than just maintaining the status quo.
So every dollar has a job, and that job is to create more value.
You got it. Then there's risk management. Old advice might have been very conservative, don't take risks. But modern finance recognizes that some level of calculated risk is necessary for growth. It's not about avoiding risk entirely, but actively identifying, assessing, and mitigating financial risks. That means having insurance, diversifying your investments, and understanding the potential downsides of every decision.
So it's not a no-risk strategy, but a smart risk strategy.
Exactly. Which brings us back to diversification, but in a much broader sense than just stocks. It's about spreading your investments across different asset classes: stocks, bonds, real estate, maybe even some alternative assets if it fits your risk profile, but also across different industries, geographies, and investment vehicles. It's about not putting all your eggs in one basket, but having many baskets of different sizes and materials.
And that minimizes the impact if one particular area underperforms.
Absolutely. It creates a more stable, resilient portfolio. And finally, something that was non-existent for our grandparents: leveraging technology. We have an incredible array of modern financial software and apps at our fingertips today. Tools for budgeting, expense tracking, investment analysis, even AI-powered financial advice. Ignoring these tools is like trying to navigate with a paper map when you have GPS.
That's a powerful analogy. From micro-investing apps to sophisticated portfolio trackers, technology has made managing our money so much more accessible and efficient.
It truly has. So, to sum it up, modern financial management is about being educated, strategic, diversified, risk-aware, and tech-savvy. It's about moving away from static, one-size-fits-all rules and embracing a dynamic approach that adapts to your individual circumstances and the ever-changing economic landscape.
This has been an incredibly insightful discussion, Jane. It's really about taking ownership of your financial education and challenging those ingrained beliefs. Don't just accept advice because it's old or traditional. Look at it critically through a modern lens.
Exactly, Bob. Financial literacy.